Welcome to TheMBI.com. This is John. This report is for the 4th of April. Well, as things get worse, the market improves because obviously the Fed is going to have to ease everything and throw money at the situation. And that is positive for the market. What are we talking about? Obviously, some slight changes in unemployment, manufacturing looking pretty weak. Obviously, commercial real estate in certain sectors having trouble. So, starting to get some of these building signs of, the interest rate hikes actually having the effect that they're designed to do. Um, NQ still at its peak, and of course you've seen tech doing their layoffs and that, and then eventually this stuff becomes accumulation to where it finally has an impact on other things. Like we say, one person losing their job, it starts to snowball because they're not buying goods, they're not doing this, that, and the other, and it has an impact. And from that standpoint, people think peak rates have hit, so treasuries are still being sought, and that's reducing yield. Not too shocking. And from an oil standpoint, that discount of number of barrels being produced certainly going to have an impact, and that's not going to be great on inflation. So you're going to get stuck with this old model from the 70s, stagflation, reduced oil capabilities and so on, and couple that with ever-changing geopolitical with this whole movement to move away from the dollar. Um, yeah, yeah, that's what we get with the trade station. It just randomly pops in and out. But I think it's just a interesting note because at this particular stage, you've got Russia on the verge of destroying the Ukraine army, and uh, whether the U.S. escalates that, the impacts for the market there. There's just a lot of unknowns at this particular stage still taking place. Um, and in the face of fear, uh, long side trade tends to be the one that usually captures it. Most people are like terrified to do it, and that's what provides the edge because you've got plenty of shorts piling into it. Even in this case, you see the euro still climbing. I mean, we're back now over the 109 mark. Insane for what's going on in the eurozone. But hey, that's exactly what this idea of devaluation from the currency, and I would expect our next leg of Bitcoin and gold to continue their next segment higher. Um, right now, there's just been a consolidation, but I think as things start to weaken, we'll get a better clue of how that's going to go from an intraday standpoint. You can see we have some pretty good sized ranges, and they're usually pretty clean. So from that standpoint, wow, that's fantastic to trade them, and they're having good duration. And this is just that mean reversion that they're just going to keep climbing with, and take some shorts, they'll get some benefit, and then they keep adding in, and it just repeats the cycle. But it does give those bursts of these long uh, spurts to the upside. And we obviously have our algo levels, and they're still reacting quite perfectly, even when we started from earlier at 41.23, then here at the 30, and then going up at the 40.49 level right now, exactly being hit. Didn't quite get up to that 57. So that's the long and the short of it for now. As always, though, look for me on Skype chat. Trade well.